We've got Ramin Nakisa joining in. He's the founder of PensionCraft. Ramin, quite a lot to talk about in terms of, again, monetary policy. We have the minutes of the last FOMC meeting that are out, and I think a lot of people building up expectations of another 50 basis points hike. Some of the members of the FOMC stating quite clearly that they will have to keep interest rates elevated for a protracted period of time to control inflation. At the same time, you have jobless claims that have come in at 250,000 for the week past, slightly lower than what was expected. That's positive. So economy holding out, would you say?
Yeah, it's interesting. I mean, the day after they announced their policy was the day when we got the second negative GDP growth number. So I think a lot of markets took this as being kind of dovish, but I think if you read the minutes, that's certainly not what I see. I see a Fed that seems very intent on being absolutely aggressive with trying to get inflation under control. So, as you say, even once they have inflation under control, they say explicitly that they're going to have to keep rates at a restrictive rate for some time in order to get inflation under control. I mean, if you want to use some kind of cheesy metaphor, I think a good one is you can imagine you're cruising down the highway or the motorway at 100 miles an hour down the inflation highway, and they've slammed the brakes on. But once you reach 90 miles an hour, you don't take your foot off the brake. You know, they're going to have to keep that restrictive policy in place until they see really good progress towards their 2% target. And I think markets are underestimating how difficult and protracted that process is going to be, and also painful for the economy.
The question then is, how much damage do you think, and this is something I think a lot of people are asking, how much damage do you think the Fed will allow the economy to withstand and will continue to hold firm to its inflation target? At what point do you think that they will blink, if they blink at all?
Well, I think they do blink. I mean, if you look back in history, usually the point at which they stop hiking is when something breaks. You know, the money market breaks, there's a liquidity problem. But I think at the moment, it's very difficult to see signs of real difficulty in the US economy. You look at the unemployment rate, you look at the tightness of the labor market, it's still the case that we have not much less than 2 available jobs for every person who's unemployed. That's incredibly tight. And, you know, if you compare that with the UK, it's roughly one job per person that's unemployed. So very tight labor market combined with, if you look at the financial conditions indices, actually what you've seen recently over the last couple of weeks is that there's been an easing of monetary conditions. So, you know, the Fed is going to be able to see that. And I think they're probably going to get even more aggressive as time goes on. So September, I think, is more likely to be 0.75 than 0.5, simply because of this easing of financial conditions that we can see. And if you look at the equity market, you've got stocks like Bed Bath & Beyond going crazy. We've got the meme stock thing coming back. You know, that's not a sign to me of an economy that's hurting, quite the opposite.
We will speak soon enough, Ramin, and figure out whether your prediction of a 75 basis point rate hike comes true. Thank you so much for taking the time.
Thank you, Alex.